Welcome to the Short-Term Rental Playmaker Podcast, where we break down what it really takes to win in short-term rentals in today's market. From insider tips and emerging trends to real conversations with top playmakers in the space, this show gives you the tools, strategies, and mindset to build and scale a successful short-term rental business. Now, here's your host, Joe Roney.
Today's episode is brought to you by Savvy STR Agents, the short-term rental real estate experts helping investors find profitable vacation rental properties nationwide. If you're serious about scaling your STR portfolio, Savvy STR Agents should be your first call.
Hey guys, welcome to another episode of the Short-Term Playmaker Podcast. Super excited to talk some financing today with one of the best in the industry with STR Home Financing, Jeff Chisum. Welcome. How you doing?
Hey, I'm doing great. How are you today?
I'm doing great, and this is perfect timing. You know, you reached out. We've kind of been talking a little bit through online for a while, and with the way the market's going and the way real estate industry is going right now, I felt it was the perfect time to have you on to talk about what's happening in the mortgage industry, because it's a great time to buy.
Yeah, no, I think there's great opportunity. We're in more of a balanced market. And, you know, financing rates have been lower, but they've also been a lot higher. So I think we're kind of, in a sweet spot where people, if they're not ready to take action, they should be, because it's just a healthy time to buy is the way that I look at it.
It is. I mean, it's a buyer's market, right? I mean, it's, you know, we're negotiating seller credits. We're negotiating, prices down. We're negotiating all kinds of stuff to get good deals for people that want to jump in the short-term rental industry. And obviously, the one thing that I will say, and the reason why I wanted to have you on, is I have so many people that call me and they say, oh, I have my local lender that I've worked with and I've bought so many houses with this, or I have long-term rentals with this lender here. And having someone like you on that deals with short-term rentals on a daily basis, tell me why that's different for our listeners, why they should be talking to a lender that deals with short-term rentals daily.
Yeah, so I've been originating since 2008, and then bought my first short-term rental in 2020. And as I became a part of different groups, I found that there was tons of misinformation out there around the second home occupancy loan. So that's what I used when we bought our lake house, and really had that information in my back pocket from probably 4 or 5 years before that, where we had received one of these industry bulletins about changes with the second home occupancy loan. And you know, my first thought was, this seems pretty significant. But at the time, you know, I was just your average loan officer doing local deals on primary residences, and didn't really know about that world. Didn't work with, you know, many investors. And so, I used that to my benefit, and then just found out there was tons of misinformation around the product. So, you know, and I still get it to this day. So, you know, today, this vacation home financing, short-term rental financing is 100% of my business. And we did our first loan in 2020. By 2021, it was 100% of my business. And so to this day, I'm still having conversations with people that talk to a loan officer about, you know, going and buying a home in Florida. They live in Chicago, and the loan officer never asked them, hey, do you plan on staying in that property at all? It's just the only thing that they hear is, and one of the things that I try to coach people from doing is not mentioning that it's an investment property, because that automatically throws that loan officer into that mode of, oh, they're buying a rent house. Yep. So with that, they go down that road of investment property loan, and it's, you know, 20% down. The rate's going to be significantly higher than what you would get on the second home. So it to this day, it's a common conversation that I'm hearing people, you know, with that information, along with other information around distances and You can't have a property manager, and there's quite a lengthy list of misinformation out there, and it boils down to, yeah, it's not their expertise. They kind of dabble in it, or the loan officer sees one of these deals every once in a while, and if that is the case, yeah, they're not going to be an expert on the policy and have dissected it the way that we have to make sure that we're leading people in the right direction, on the right product.
Yeah, I agree. And I'll be honest, I was one of those that made a mistake. Our first short-term rental, I called my local lender, who I'm a residential realtor in St. Louis. I primarily do investment properties in Florida now, but my career started with residential in St. Louis, and I just called the lender that I always recommend and said, "Hey, do you guys lend in Florida?" And she's like, "Oh yeah, we do, and we have investment property." And it was 20% down, and it definitely was probably half a point higher than if I would have gotten a second home loan. And in hindsight, I would have saved money, or I would have made more money if I would have gone through the right lending. And that was my own mistake in our very first purchase. We did a great job underwriting and understanding short-term rentals, but I didn't do the research on the lending. So that's why it's really important. So second home loans is a big part of what you specialize in. And what other loan products do you guys recommend for people that are getting into this industry?
Yeah, so 90% of my business is that 10% down second home occupancy loan, and it's typically going to give us the best interest rate out of any of the products that we use outside of our primary residence. And that's something that we really had to fight for. And that's the other thing that's worth mentioning when people are talking to other loan officers is 98% of the world out there in lending, they are originating these loans for Fannie Mae and Freddie Mac. So 3 years ago, I believe it is now, years kind of run together, but Fannie and Freddie said, "Hey, we want to deter people from buying in this asset class because we feel like they're buying people's potential primary residences." So they raised the fees on that second home occupancy loan, and they're still there to this day. So what we've really had to fight for is to find an alternative to Fannie and Freddie, for an investor that understands there's an opportunity that went away. How can we bring it back? We're going to offer our own product. So for a comparison, most of the world's going to be at like 7.25. You may pay like 1 to 3 points if the lender's going through Fannie and Freddie. Here recently, we've been locking in, this is on a 30-year fixed rate, 6 5/8 with no points. And that's going to be for someone that has excellent credit, and that, can qualify, of course, but it's a significant opportunity. And that's the other thing worth mentioning, in talking to someone that specializes in short-term rental like myself, is I've really had to fight hard to make sure that we were giving our clients the best of the best. Not only beyond our expertise, but on interest rates and costs. But to answer your question, second place would be DSCR. So, 90% of my clients that are using that 10% down loan are W-2 wage earners typically. And then the clients that are utilizing that DSCR loan are typically self-employed. So the big deal about DSCR is debt service coverage ratio. We're not going to use someone's personal income to qualify for the loan. It's going to be based on the property's ability to show income that would meet or exceed the principal, interest, taxes, and insurance payment.
Yep.
So, people that are self-employed get frustrated because they don't qualify for what the rest of the world qualifies for. So it's been a good alternative, a good route for people to take that aren't going to qualify for that conventional financing.
Yeah, that's our actual most recent short-term rental purchase. We actually had to go that route because, like you said, my wife and I, neither of us have W-2s. Neither of us have had that in over a decade. We had enough for that first short-term rental, but then your DTI gets cut off really quickly when you're going for those second home loans. So especially for self-employed, that DSCR allowed us to scale without having to, significantly increase our income because we were already, on that bubble on that DTI. And that's something that's not part of that, right?
Yeah. And it's, the population of people that are going to use that DSCR are self-employed, but then also the people that they may be W-2, but they maxed out their debt to income ratio. So they kind of ran out of room to be able to do another 10% down loan, but they still want to scale at a certain rate. So the DSCR loan gives those people the ability to continue to purchase and acquire for their portfolio without having to worry about conventional financing. So the big deal there is going to be the 20% down payment. There are some 15% down options. In some cases, in some scenarios, it could be 25%. And that's the other reason why you want to deal with someone that specializes in short-term rental financing, because they're going to know what that down payment requirement is going to be up front versus someone who doesn't have a lot of experience. And it could be, in fact, I just saw this yesterday somewhere where is it all the same with DSCR lenders where they tell you one thing and then you get into the deal and it ends up being something else. And I would say, yeah, that's probably pretty common because your typical loan officer doesn't do DSCR deals on a regular basis. And they probably don't do DSCR deals for short-term rentals on a regular basis. So yeah, and I've got a podcast episode that I did on what you need to ask the lender about DSCR financing, because it really was from a position of getting pretty fired up about some of the things that I was seeing out there that really kind of tarnished the industry as far as how loan officers were operating in that space. And a lot of people don't know you don't even need a license to originate a DSCR loan. So that brings a whole population of people that aren't familiar with the regulations and compliance pieces. And they just kind of tell people whatever, and they don't tell people everything. So we have a client in a deal right now. They flipped over to us because a loan officer tried to steer them to a DSCR loan. And then their realtor told us to maybe talk to us to get a second opinion. And we told them, hey, your $3 million beach place, that sounds like a place you guys are going to want to go. Did you know on the DSCR loan, you're going to sign an affidavit that says you're not supposed to use that? So yeah, there's definitely nuances, things that can bite you potentially if you don't have a good team around you.
Yeah. No, I agree. And the other thing that I like to talk about, and you mentioned your podcast, STR Home Financing podcast, highly recommend to get information in all of this. One of the biggest mistakes that I see that when a potential buyer brings me their lender and they say, oh, this person's done DSCR loans for me on all of these long-term rentals. And then when I have a conversation with them, I ask them about, are they using AirDNA data or how are they underwriting? And they're like, oh no, we need to look at your long-term rents down in Florida at the beach to see if it would cover. I'm like, well, the $3,000 a month in long-term rents is not going to cover this $800,000 or $1 million purchase. So that's not going to work. So being able to use, I'm assuming, AirDNA data and other comps when you're actually doing these underwriting.
Yeah, and that's a great point, because one of the questions I get all the time is, how do I get pre-approved for a DSCR loan if it's not based on my income? So, we still have to pull credit. DSCR loan, you're typically going to be a personal guarantor. So that's why we're looking at personal credit. We're using that credit score to base pricing on the interest rate. But yeah, it definitely is something to know going into it, that can I do the deal in this area or not? Or am I just spinning my wheels? So we take an application. It's one application for all products. We pull credit to verify credit. We verify you have the down payment requirement. We verify that you have 6 months in reserves, which is typically the reserve requirement for the subject property. And then from there, it's, okay, where do you want to buy? And because we've been doing these for 4 years, we are, accustomed to using AirDNA to pre-underwrite these deals. We can tell someone, yeah, if you're looking for a 4-bedroom, 3-bath in this market area, we're showing that income is solid, that we're not guaranteeing that income, but from a loan approval standpoint, everything looks great. Go for it. And then they find a property, we run it again for them. So that's typically what, a pre-approval for a DSCR loan looks like. And, because we've done a lot of these, we can save people time and effort, from going into a market that, isn't going to work out from an approval standpoint.
Yep, and I'm going to throw a real estate agent plug in there because on top of this, having a realtor in that market that actually understands short-term rentals, owns short-term rentals, and can actually pull real data, because AirDNA data is great. It's still scraped data, but like I have 10 properties that we co-host in my market. I can pull real data from 10 properties to say, yep, this $789,000 property is going to, I have 3 houses doing $145,000 on it. We are exceeding, here's real data.
Yeah, no, absolutely. And I encourage people on a regular basis, make sure that you're connected with an expert when it comes to your buyer's representation. Not just someone that has a license in the state or does deals in the area, that they're a short-term rental expert and they've got some skins on the wall. They can show you proof that they are experts. They don't just kind of talk about it and, they're part of some groups. So yep. That's a great point.
Yep. I like to always do the comparison of, if you were going to get a divorce, you would go to a divorce attorney. You wouldn't go to a attorney that handles criminal law, right? Or vice versa. And in this industry, you should go to the people that are the experts in the industry. And, investment property, whether it be your personal home or an investment property, these are still going to be one of the largest purchases you make in your entire life as an investor, as a homeowner, as anything. There's not much that you're going to spend more money on. Why would you not want to have an expert representation on both the buyer side, the lending side, and on the insurance side? And one of the things we're doing at Savvy, we actually have an STR insurance provider that's now specializing in STR insurance in all the different states that we're working with. So it's like, why wouldn't you want to have somebody that's an expert in all those areas representing you for the largest purchase that you're potentially going to make?
Yeah, no, that's a great point. And I use the analogy because we work with a lot of physicians, and I mean, you and I are not dealing with life and death, but yeah, it's just that idea of if you were having significant headaches, you wouldn't go to a podiatrist. You're going to go to someone that knows the brain, that has been in the brain, that is an expert with the brain to advise you. So yeah, that I love that. Just visualization of, well, you wouldn't do it here. Why would you do it in this situation? And, you and I deal with clients typically that kind of they've earned their way to this position in life. So they've, they're beyond the ends meeting from a personal income standpoint, personal finance standpoint, very educated, very smart. So they understand the value when you talk to them about having the right people around you. So it's not a hard conversation.
So it's interesting that you say that, because I'm going to throw it the other way. The majority of the people that are buying short-term rentals, we're not actually helping. And I'll give an example of a client of mine that purchased her short-term rental with a realtor that didn't understand short-term rentals, was told a house was going to do X, and the appraisal came in low, and she was talked into paying $100,000 over the appraised value because it was going to be such a great property. And here we are 3 years later, and she's losing $30,000 a year on a property that she paid over $100,000 over the appraised value for, because she didn't use the right people. And there's, as many transactions as we do at Savvy, as you do, as some of the other STR lenders do, we're still a small fraction in the grand scheme of things when you think about how many people that are jumping into just buying that second home loan. And that's why these podcasts are so important, because the people that we talk to, we're talking to savvy investors that understand what they're doing. It's these new investors that we've got to get out to be able to prevent them from making these major mistakes.
Yeah. And I think that brings up the point that don't just take someone's word for it. Make sure that you dig in and you ask some questions, or you do some research on their background and their expertise, and just to make sure that they are the real deal.
Yeah, I agree. I agree. I mean, I tell everyone, don't trust your realtor, and I'm a realtor. That's what I do. But you got to do your own data. You got to do your own digging. And if all you're doing is taking what your real estate agent or somebody else is telling you, and you're making a purchase based on that, you're making a bad decision. You need to do your own due diligence. You need to run your own pro formas. You need to be able to understand what you're getting into, because this industry has been life-changing for me. I'm sure it's been life-changing for you. It's amazing, but I've also seen just as many people flop because they didn't make good decisions from the get-go.
Yeah, I'm a little partial, but I really do think it's the best asset class in the United States. Real estate has always been a solid investment, and now we're adding these layers to it when we get into short-term rentals, of the tax benefits, the ability to qualify for those tax benefits, the cash flow opportunities, the appreciation, but then also there's the fun factor. And I tell a little bit of my story on my website about, our journey into buying a short-term rental. And part of the value that we found through that process is we've got these 4 kids. My wife and I have been married for 30 years. We've got 4 kids, 26, 22, 16, and 12. And I'm a big believer, more is caught than taught. And so what this process showed them was mom and dad not just talking about, these ideas and these dreams that we have, but we're actually taking action. And then what that action looks like, we're doing our homework, we're doing our due diligence, we're, going into this, trying to make as educated decision as possible. And then once we get to the point where we feel like this is the right move, we're making a move on it. And then what that looks like to get a property rent ready and to do it well and to, manage it and maintain it and run a business. So yeah, I think it's, from that standpoint, we'll see the fruits of that, as they grow up, that, mom and dad model to them what it looked like to take action and be smart, be wise. And I think that is huge part of this asset class as well.
It is. I know our girls have benefited a ton from it. My youngest actually completely changed what she's going to go to college for, because she started helping my wife design, and she's going to spend a little time with Ashita this summer. And she's jumping into the design and architecture side of it in college, because she wants to join us in this asset class, helping other investors, envision and create spaces and create experiences. And so it shifted from her originally wanting to do marine biology to saying, wow, this is fun and I love it. And she's getting to do something that she loves to do.
Yeah, I love that. Well, and part of the example I give is we were researching and exploring where we wanted to invest. We looked at the stock market. I don't trust Wall Street. Started looking at long-term rentals, and we just ran into roadblocks along the way, and got into short-term rentals, and it's been great. And so in retrospect, looking back, the kids wouldn't have cared about sitting down and talking about the stock market, or, hey, let's go to the rent house and, check things out. That wouldn't have gotten them excited. But the lake house, it got their attention, it got them excited. And I think that's a great place to, create interest and, just have their attention.
Yeah, I agree. And like you said, on the asset class, I did a stand-up speaking event a couple months ago, and one of the guys that was introducing me was talking about his long-term rents, and he had 50 doors, and he was cash flowing like $10,000 a month on these 50 doors. And when I got up on the stage, I said, I'll be honest, that sounds awful. I said, who wants 50 doors? I want 3 that cash flow me $10,000 a month. Like I'd much rather be dealing with 3 houses that give me the same kind of cash flow than trying to manage 50 properties. And that's the difference, right? The difference is, yes, you're going to spend a little bit more money getting into this industry, and you're going to have to do some design and amenities, and you're going to have to create experiences, but that cash flow and appreciation is going to be so much higher than putting all your money into long-term rents, especially in today's market. Long-term rents is a tough market to get into.
Yeah, absolutely. Well, Yeah, I guess you and I are a little partial, but I think we, have some data to show there's some substance there for sure.
There is. So, the last lending that I was going to ask you was, have you done much with bank statement loans? Do you guys dabble in that? Is that something you guys offer now?
You were reading my mind on, hey, how can we transition to anything outside of these two products? So yeah, that's another great opportunity because, you've got people that may not have the self-employment history. You may have people that just don't fit in the box for conventional lending. So there have been, and, I think this has really come along with the popularity of the short-term rental asset class. You've got investors out there, that have created these products, and it includes a 10% down option for bank statement loans, asset depletion. So the bank statement loan is a big deal for typically people that are self-employed, where we can use 12 to 24 months of bank statements to, that are going to be more accurately reflective of someone's cash flow than a tax return would be. Yep. So then we extrapolate a qualifying income from that, and it's going to be a much higher number than you would get from a tax return. So, there's still a debt to income ratio standard. There's still, it's more like a conventional fully qualifying loan, but where we're going to get the income from is much different than, that Fannie and Freddie loan. Now the interest rate's going to be higher. It's a more risky loan in the eyes of investors because we're using bank statements. So it's just seen as riskier. And then the asset depletion, you may not have a job at all. You may not have any, income except for, maybe you have a retirement income, maybe you have Social Security, you have a pension, and that doesn't get you there. But then you've got $2-3 million in investment accounts. We can take that investment, total investment amount, extrapolate a qualifying income amount from that. So it's another way that people that aren't going to fit in that Fannie and Freddie box for conventional lending to be able to do this. And we have 10% down options for that asset depletion as well.
That's huge because the ones that I've talked to on the bank statement are still in, some of them are in that 15 to 20, but 10% bank statement loan is, that's a good deal because that's actually one of the loans we're looking into for our next STR purchase, because it seems like it might be a little bit better terms than a DSCR when it's all said and done, or similar terms, but maybe less points. Are you seeing anything like that?
Yeah, the DSCR loan is, because of the popularity that has grown with that product, the interest rates have been really good. I mean, we saw January of 2025, I believe we were in double digits, and now we're below 7% on the DSCR. Yeah. Now, when you get the better pricing on that product, typically it's going to come with a prepayment penalty. So it's basically, if you pay the loan off within 3 years, which, is either paying it off outright or refinancing, would be paying the loan off to get a new one, then you're going to pay this penalty to get out a loan. And it could be, 1%, 2%, 3%. Some lenders are charging 5% of the remaining loan balance. So that looks different, but it's still going to be somewhat significant. So even though you can get that lower interest rate, you have to keep in mind, it probably needs to be the 3-year plan, part of the 3-year plan, because I don't want to have to pay those penalties.
Yeah. No, I agree. Last question I have for you on lending is refinancing, because a lot of people did buy when it was 8%, 9%, 10%. And now that we do have interest rates coming in below 7, for instance, my DSCR is a 7.625. I had a 1-year prepayment penalty, which I'm past now. So what does a refinance look like right now? And is that something you guys are able to handle?
Yes, it is. And we're seeing quite a few of those. So, whether it's people trying to, improve their cash flow position or take some cash out, we're in kind of that window for that period of time where rates were over 7.5%, close to 8%, where we're able to get that 1% decrease in the interest rate, which is typically kind of the rule of thumb for refinancing. That's going to give you a break-even period on the closing cost of within 2 years. Mm-hmm. So that's kind of the general rule of thumb. It's going to vary based on loan amount. So you could have a $2 million loan. You could get a 0.5% deduction in interest rate and get a pretty quick payback on, the return on the closing cost versus the savings. So that's going to vary, but we've definitely seen, an influx of those. The other thing that I would mention is you've got quite a few people that purchased in 2021. I don't want to brag, but I'm one of those people that bought in 2020, and my 30-year fixed rate is at 2 5/8. So you've got a bunch of those people that are like, I will never let anyone touch that. In fact, I would be hard pressed to sell this property to let go of this interest rate.
Yes.
So then the challenge becomes, okay, now I have all this static equity that I'd like to tap into, but I don't want to touch that interest rate. So there's a lot of options when it comes to HELOCs that you can take out on these properties. So, excuse me, there's going to be fully qualifying, but then, you can get to DSCR HELOCs. So it's the same thing as the DSCR purchase, DSCR refinance, where we're not going to look at your personal income. It's going to be based on cash flow of the property for the approval. And that hasn't been there, very long. And that had been a big need in the industry, was for, great, you've got these people that are being served that can qualify these through conventional means. What about the pool of people that they're self-employed and they can't? So that's another great opportunity to leave that low interest rate alone is the HELOC.
Yeah, no, I agree. I think that is a huge opportunity. I've talked to a few different people that said they were tapping into that equity to go purchase more and scale more properties. And if you have that 2.5% interest rate, I agree. It's hard to let that go. My personal residence is like 2.25, and we've talked about selling and moving and things like that. Nothing we're doing now, but it's like, man, that's still going to be tough to let that go.
Absolutely. Yeah, that would be a little painful.
Well, perfect. Obviously, tons of information here for people that are jumping into this industry and need to get into lending. So what is the best way for them to get in touch with you to be able to start the process, whether they want to refi, purchase, whatever it may be? Just talk about products.
Yeah. So the best opportunity to connect with me is through my website, strhomefinancing.com. And so there's just a little bit of information that you fill out, like 8 questions. And then I've got 4 videos that I put together that are about 5 minutes a piece. It takes like 20 minutes to watch all 4 of them. And really those were made as part of a necessity to minimize the time that I was spending on consultation calls.
Yep.
So it was dual benefit, because, an hour of me just sitting there regurgitating information, and then the other person on the other side of that phone call trying to stay awake through me just regurgitating an hour of information. So yes. I was like, there's got to be a better way. So I made the videos, and now we're reducing those consultation calls to 15 minutes typically. So they watch the 4 videos. There's an opportunity to schedule an appointment, hop on that Calendly link, pick the time, and then we spend 15 minutes on the phone. And really what I want to hear there is, tell me about what you're doing. I want to hear your hopes and dreams and, the things that you feel like are unique to you that we need to address, and, kind of put those things to bed, and then, direct you to the next steps in the process. Another good resource that I have out there is my podcast. So Apple, Spotify, STR Home Financing is the name of it. And those were ever since the beginning created as micro podcasts. So they're typically 10 minutes or less. And I think I have about 65 episodes or so. So a lot of good information from, we just talked about HELOCs. There's some nuances to those. There's some things that you want to make sure that you keep in mind so that you're responsible. So I touch on that, but just a lot of different subjects, a lot of interviews with industry leaders. I'll be having you on soon, so looking forward to that. But a lot of good information on my podcast.
Awesome. Definitely tons of resources out there. That's one of the things I love about this industry more than any other industry that I've ever been in is everybody is willing to give free information to truly help people. Like, I feel like everybody in the STR community really wants everyone to win. Nobody else has to lose for you to be a winner in this space. And there's tons of value and resources all over to find people to help you with that.
Yeah, absolutely. And I'd love to see your stuff out there because you're cut out of that cloth of being an educator and serving people in the best way possible, doing the right thing. So keep up the good work.
I appreciate it. And I appreciate you coming on and sharing all this info about the STR Home Financing. So listeners out there, go check it out, get ready, get pre-approved, and then give me a call so we can find you that new beach house. So Jeff, thanks again so much for coming on. And thank you guys for joining me on the Short Term Rental Playmaker podcast.